This is not a drill. This is an emergency briefing on a financial earthquake happening just under the surface of the mainstream headlines. Over the last several weeks, a significant financial maneuver appears to have begun, one that could signal a massive shift in global power. Chatter from the highest levels of European finance suggests a $9 billion dump of U.S. Treasury bonds is being discussed. This isn't just market noise, it's a potential vote of no confidence. And it's happening as political leaders in Germany and Italy are raising their voices, demanding to repatriate their physical gold, worth hundreds of billions of dollars, from the vaults of the New York Federal Reserve. This is no coincidence. It looks like a calculated move by some of America's oldest allies. They're looking at the unpredictability of a second Trump administration, the weaponization of the U.S. dollar, and the storm clouds of new tariffs. And they are starting to make a choice. They are choosing to de-risk from the United States. What we may be witnessing isn't just a transaction. It's the start of a potential economic conflict that could unravel the global financial system. In this video, we'll break down what's happening, why now, and what it could mean for your money, the dollar, and the balance of world power. The trust that has held the dollar system together for over 50 years is being reevaluated in real time, and the consequences could be catastrophic. Let's connect the dots that the mainstream financial press seems to be ignoring. The inciting incident is a story bubbling just beneath the surface, circulated in high-level financial reports. These reports suggest a potential coordinated sell-off of U.S. Treasury bonds by a bloc of European nations. Now, let's be clear. There's been no official press conference announcing, "We are dumping $9 billion of your debt." These moves never get a press release. They happen quietly, but the tremors are felt everywhere. Why would they do this? It's a powerful signal of distrust, a warning shot. For decades, the world ran on a simple premise. The U.S. Treasury bond is the safest asset on Earth. Nations held U.S. debt as their primary reserve, a bedrock of stability. Selling those bonds is a profoundly symbolic act. It says, we no longer believe this is the safest place for our money. But the Treasury chatter's only half the equation. The other, more explosive half, is the loud call for gold repatriation. In Germany, which holds the world's second-largest gold reserve, the debate has intensified. Influential economists and political figures are publicly demanding that the Bundesbank, Germany's central bank, bring home the gold stored in the United States. We're talking about roughly 1,236 tons of physical gold, worth over 164 billion euros, currently sitting in the vaults of the New York Fed. One former head of research at the Bundesbank stated bluntly, "It is too risky for the gold to be kept in the U.S. under the current administration." This isn't a fringe opinion. It's a sentiment echoed by the European Taxpayers Association, whose representative warned, "Trump is unpredictable. That's why our gold is no longer safe in the Fed's vaults." And it's not just Germany. In Italy, which holds the world's third-largest gold reserve at 2,452 tons, a similar drama is unfolding. Lawmakers from the ruling party have put forward a controversial proposal to formally declare that Italy's massive gold hoard is the property of the Italian people. On the surface, this sounds like a populist political statement. In reality, it's a shot across the bow of the European Central Bank and a move to assert national control over a key strategic asset. The message from Rome is clear. In a crisis, this gold is ours. The whispers in the bond market and the roars in the political arena are telling the same story. Europe is preparing for a world where it can no longer unconditionally trust the United States to be the custodian of its wealth. So, the big question is, why now? What has suddenly turned this long simmering distrust into an active, unfolding situation? The answer, in a word, is Trump. The unpredictability of the administration has acted as a powerful catalyst, forcing nations to reevaluate decades-old assumptions. The central miscalculation seems to be the belief that the U.S. can use economic pressure, like tariffs and sanctions, without consequence. The administration's aggressive trade policy is built on leverage, the idea that the U.S. can impose its will because other nations need the American market more than America needs them. But what if that leverage isn't absolute? We are seeing the backfire from this strategy. European nations, once considered steadfast allies, are now seeing U.S. policy not as a partnership, but as a source of risk. The threat of broad tariffs changes the economic math for Europe. When tariff threats were announced in the past, Treasury yields rose, signaling market anxiety. This aggressive stance creates a powerful incentive for countries to diversify away from the U.S. dollar and its debt. Why hold your national savings in the currency of a country that is actively trying to undermine your economy? It's like keeping your life savings in a bank whose manager has publicly declared he thinks you're a freeloader and plans to change the rules on you without warning. And this isn't just theory. Every tariff threat reinforces the perception that the U.S. is no longer a reliable partner, but an unpredictable power. This creates a toxic feedback loop. The more the U.S. uses its economic might as a weapon, the more other countries are pushed to build their own economic shields. Gold is the ultimate shield. Unlike treasuries, it can't be devalued by a tweet or sanctioned with a pen. It carries no counterparty risk. The language from European economists is telling. They aren't just talking about market cycles. They are talking about strategic independence and geopolitical risk. This is the language of a fundamental realignment. The miscalculation was assuming America's allies had no other choice, that they would just absorb the economic pain. But they do have a choice. They can sell bonds. They can demand their gold back. They can accelerate their move into a multipolar currency world. The current actions suggest they are not just considering that choice, but actively beginning to make it. The administration, in its attempt to project strength, may have inadvertently triggered a sequence of events that could permanently diminish American power. To really get the urgency behind Europe's recent moves, you have to look at the one event that shattered the illusion of trust in the modern financial system: the freezing of Russia's foreign currency reserves. That was the moment the world changed, sending a shockwave through every central bank on the planet. For decades, the global financial system ran on a sacred, unspoken rule. Central bank reserves were untouchable. A country's sovereign wealth, held in currencies like dollars and euros, was considered sacrosanct, regardless of politics. This was the bedrock of trust. In 2022, that belief was annihilated. In response to the conflict in Ukraine, the United States and its allies froze approximately $300 billion of Russia's central bank assets held in their jurisdictions. From a political and moral standpoint, the reasons were clear. But from a financial standpoint, it was like setting off a bomb in the heart of the global banking system.
The message it sent to the rest of the world was terrifyingly simple. If you fall out of favor with the United States, your national savings can be seized overnight. your access to your own money can be cut off. The very foundation of your country's economic stability, your foreign reserves, are not truly yours. They are held at the pleasure of the U.S. Treasury Department. Immediately, finance ministers and central bank governors everywhere asked themselves a chilling question. Could we be next? They saw that the dollar wasn't just a currency, it was a weapon. And the decision to use it had crossed a line many thought would never be crossed. This isn't about being anti-American. It's a rational response to a new and dangerous reality. Any country holding significant dollar reserves is now forced to view those reserves not just as an asset, but as a potential liability, a source of profound geopolitical vulnerability. The Russian precedent shows that financial sanctions are a primary instrument of foreign policy. This single event did more to accelerate de-dollarization than anything in the last 50 years. It is the primary driver behind the record-breaking gold purchases by central banks since 2022. Countries are desperately seeking a neutral reserve asset that cannot be frozen or confiscated. Gold is the only asset that fits that description. It's physical, it's finite, and its value isn't dependent on the political whims of any one nation. When German economists today talk about the risk of holding their gold in New York, the ghost of Russia's frozen assets looms large. They aren't just worried about tweets. They're worried about a world where the rules have been irrevocably broken. The demand to repatriate gold is the logical conclusion of the lesson learned in 2022. The only assets you can truly count on are the ones you hold in your own vaults. The current crisis, though kicked into high gear by recent events, isn't new. The seeds of this transatlantic financial mistrust were sown over half a century ago. To understand the deep-rooted anxiety in Europe, we have to rewind to 1971 and an event known as the Nixon shock. After World War II, the global financial system was rebuilt under the Bretton Woods Agreement. The U.S. dollar was crowned the world's reserve currency with one critical promise. It was convertible to gold at a fixed rate of $35 an ounce. Any country holding dollars could, in theory, exchange them for physical gold. By the late 1960s, however, the U.S. was in trouble. Facing the immense costs of the Vietnam War and domestic spending, it was printing far more dollars than it had gold to back them. European countries got nervous and started calling Washington's bluff, redeeming their dollars for gold and draining U.S. reserves. On August 15, 1971, President Richard Nixon made a stunning move. Without consulting any allies, he unilaterally severed the link between the dollar and gold. He closed the gold window, effectively defaulting on America's promise to the world. For the international community, this was a profound betrayal. The United States had changed the rules of the game overnight to suit its own needs. This was the original sin of the modern dollar system, a moment seared into the institutional memory of every European central bank. It taught them a hard lesson. The United States will always act in its own self-interest. This history is crucial for understanding Germany's actions today. The memory of the Nixon shock is why Germany began a push for gold repatriation long before Trump. Between 2013 and 2017, the German Bundesbank undertook a massive operation to bring 674 tons of gold back to Frankfurt from New York and Paris, citing the need for public trust and confidence. But the underlying message was clear. Germany wanted more of its sovereign wealth under its direct control. However, a significant portion, the 1,236 tons now at the center of the debate, was deliberately left in New York. The reasoning was that New York is a major gold trading hub. It was a compromise between sovereignty and convenience. Now that compromise is breaking down. The combination of the Russian sanctions precedent and the Trump administration's unpredictable policies has tipped the scales. The convenience of keeping gold in New York is now being overshadowed by the geopolitical risk. The history of mistrust, from the Nixon shock to today, has created a deep-seated skepticism in Europe. They've seen this movie before. They've seen the U.S. change the rules without warning. And now, they're taking steps to ensure that when the next crisis hits, their ultimate financial backstop, their physical gold, is safely on home soil.
We're getting into the weeds on a topic that could affect everyone. If you're finding this breakdown valuable, and if you believe in understanding the forces shaping our world beyond the mainstream narrative, then take a second to subscribe to the channel. Hitting that subscribe button and turning on notifications ensures you won't miss our future investigations into the critical shifts happening in the global economy. Your support allows us to continue doing this research. Now, let's get back to connecting the final dots. The events we've discussed, the Treasury dump chatter, the calls for gold repatriation, the specter of tariffs, aren't isolated incidents. They're data points in a much larger structural shift, the global trend of de-dollarization. This is arguably the single most important financial story of our time.
For more than half a century, the world has run on the U.S. dollar. It's the lifeblood of international trade and the primary reserve asset for central banks. This has given the United States what's famously been called an exorbitant privilege. America can print the currency the world needs and run massive deficits without immediate consequence. But now, other countries are looking for alternatives. De-dollarization is the slow, deliberate process of countries reducing their dependence on the U.S. dollar, and it's accelerating. According to the International Monetary Fund, the dollar's share of global foreign exchange reserves has been in a steady decline, falling from over 70% at the turn of the century to below 58% recently. The primary beneficiary of this shift has been gold. We're in the midst of a historic central bank gold-buying spree. After the Russian asset freeze, net purchases soared. According to the World Gold Council, central banks added a massive 863 tons to their reserves in 2025 and are on pace to continue this trend. Who's buying? It's a global phenomenon. China, Russia, and Turkey have been major buyers for years. But the trend is broadening, with countries like Poland and India also making significant moves. A World Gold Council survey revealed a crucial statistic. An overwhelming majority of central banks now say they plan to keep their gold reserves within their own country's borders. One central bank official put it plainly. "We did have it, gold, held in London, but now we've transferred it back to our country to hold as a safe haven asset and to keep it safe." They are diversifying because they are losing faith in the U.S. dollar as a neutral store of value. The weaponization of the dollar, coupled with America's soaring national debt, now over $38 trillion, has created a crisis of confidence. Foreign nations are looking at the United States and seeing a country that is both increasingly willing to use its currency as a weapon and seemingly unwilling to get its own fiscal house in order. That is a toxic combination for the world's reserve currency issuer. This is the bigger picture. The reported Treasury dump is a small step in a much larger journey of diversification. The demands for gold repatriation from Germany and Italy are a physical manifestation of this same de-risking strategy. They are taking chips off the dollar table and putting them onto a neutral asset that has held its value for millennia. This isn't a conspiracy. It's a logical, strategic response to a rapidly changing and unstable world.
So, what happens next? What are the real-world consequences if this trend keeps accelerating? We aren't talking about a minor market correction. We're talking about the potential for a financial earthquake. First, consider the impact on the U.S. economy. The dollar's value is based on supply and demand. For decades, the world has had a near insatiable demand for dollars and U.S. Treasury bonds. This has kept the dollar strong and U.S. interest rates artificially low. If the world starts buying even marginally fewer U.S. bonds, the equation flips. Reduced demand means the U.S. Treasury will have to offer higher interest rates to attract buyers for the trillions in new debt it needs to issue. This creates a devastating feedback loop. Higher interest rates mean the cost of servicing America's $38 trillion national debt explodes, leading to even larger deficits. Those larger deficits require issuing even more debt, which further spooks foreign investors, leading to even higher rates. At the same time, higher rates would slam the brakes on the U.S. economy, making mortgages and car loans more expensive and likely triggering a severe recession. The impact on the dollar would be profound. As nations sell dollars to buy gold or other currencies, the dollar's value would fall. A continued decline would mean the cost of everything the U.S. imports would skyrocket, fueling inflation for American consumers. Globally, the consequences would be just as dramatic. The end of the dollar's uncontested reign could usher in a chaotic, multipolar currency world. Gold, as the only politically neutral asset, would likely see its role elevated. Projections that once seemed bullish, like gold hitting $4,700 an ounce, are now becoming the consensus, with some analysts seeing prices push toward $5,000 by the end of 2026. There are even speculative analyst reports suggesting a potential shift of over $800 billion out of U.S. assets by the Eurozone by 2028, if this trend escalates. While that's a projection, it highlights the scale of the risk. A collapse of trust in U.S. Treasuries wouldn't just be a problem for Washington. It could trigger a global crisis. This is the endgame. A potential miscalculation by the U.S., believing it could wield the dollar as a weapon without consequence, triggers a crisis of confidence. That crisis leads to a flight from U.S. debt and a scramble for physical gold. This, in turn, risks a feedback loop of higher U.S. interest rates and a falling dollar, culminating in a global financial crisis and the end of the American-led economic order. This is the path we appear to be on. Let's be clear. This isn't a definitive prediction of the future. It is an analysis of what is happening. It is the connecting of dots from the political firestorms in Berlin and Rome to the hushed movements in the Treasury markets and the undeniable super trend of global de-dollarization. The central thesis is this: the trust that held the post-1971 dollar system together is being fundamentally reassessed. For decades, the world accepted the dollar's exorbitant privilege as a trade-off for the stability and security that American leadership provided. That trade-off is now being questioned. The weaponization of the dollar through sanctions, the unpredictability of U.S. trade policy, and America's own spiraling debt
have created a perfect storm of distrust. The actions we are seeing from Europe aren't an act of aggression, they're an act of self-preservation. When allies who have based their economic security on the U.S. financial system for over 70 years begin to actively de-risk, it's a signal that can't be ignored. The demand to repatriate physical gold is the most powerful signal of all. It is a declaration that in the face of unprecedented uncertainty, only a tangible, sovereign asset, held in one's own vaults, can be truly trusted.
This isn't just a forecast. It's an analysis of a crisis already unfolding. The shift away from the dollar and towards neutral assets like gold is no longer a fringe theory. It is a documented reality. The only remaining question is how fast it will accelerate and what the ultimate consequences will be. The tectonic plates of global finance are shifting, and the tremors are just beginning to be felt.